Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us is Steven Ehrlich, director of research of digital assets over at Forbes Crypto. We're going to take a look at a few things that investors need to know before going to the Thanksgiving holiday as it relates to the crypto space. Steve, it's great to see you as always. Welcome back to Trade Talks.
Great. Thanks, Jill.
You got it. And it's interesting. You're on just about 4 weeks ago when we spoke about cybersecurity within the crypto space as it relates to Cybersecurity Month. And here we are and how different the world looks in just 4 weeks. And so let's talk about Bitcoin specifically, briefly dropping under 16,000 and crypto's market cap fell below 800 billion. What do you think is behind this?
It really just stems from investor fears about the next spots for contagion and kind of what is the next shoe to drop. As I'm sure you've covered endlessly on your show over the past couple of weeks, Sam Bankman-Fried really was seen as the friendly face, the regulatory compliant face of crypto. And when his $32 billion exchange collapsed, it reverberated across the entire crypto ecosystem. And investors right now, the market is a little bit jagged. Investors are on pins and needles, and there's been a few spots or potential spots of contagion that the next group of companies that people are wondering if they're going to fall, including some very big names. Genesis Lending, Genesis Trading, which is a big part of the digital currency group umbrella under Barry Silbert, recently had to pause withdrawals from its lending desk, which spooked markets. Grayscale, the asset manager that's also under digital currency group with a $10 billion plus Bitcoin focused fund, Grayscale Bitcoin Trust, is trading at a discount of about almost 43%. Right now, that means that the shares are trading on the open market at about 57% of the net asset value tied to each one of those shares. Those are actually linked because there are questions about if digital currency group needs to bail out Genesis, which is rumored to be considering bankruptcy. It might need to liquidate its own shares of GBTC, which could hurt that price even more. And then BlockFi too, which is a multi-billion-dollar lender that actually ran into serious trouble in May, stemming from the Terra Luna crash and 3 Arrows Capital crash, where they had to take a 9-figure bailout from FTX, and obviously they've had to pause withdrawals as well because of their very obvious exposure to FTX. And as we saw from 3 Arrows Capital and the Terra Luna crash, where sort of the contagion sometimes it takes months and months, and it likely is going to take years to fully reveal itself. FTX was orders of magnitudes bigger than that. So people are really wondering what shoes are going to be next to drop.
Steve, it sounds like this all centers around leverage, right? And we kind of seem to have these risk management and leverage conversations once every 10, 15 years, whether it's equities or sophisticated products are being packaged, whether it's digital assets. I'm sure we'll be talking about this in another 10, 15 years with a new asset class that emerges or a new type of product that emerges. So it sounds as if, particularly with digital assets, since there's only a finite number of them, like, Bitcoin only has a finite number that's available, perhaps leverage doesn't make sense in this space.
Right. I mean, leverage really is a dangerous cocktail, as you mentioned. I mean, it can serve a purpose if used properly, but leverage can also lend itself to greed. And a lot of people that were running these big funds, these big trading desks, FTX and its group, obviously notwithstanding, many folks imagine that based on their quantitative backgrounds, their prestigious academic degrees, that they were doing the trading equivalent of what's seen as like 3-dimensional chess, and that didn't seem to be true at all. If leverage is not managed properly, it can be devastating to markets, and in crypto in particular, because of the auto forced liquidations when there are short squeezes or long bets have to be liquidated. And leverage really has a purpose, and it's not just a gamble on prices. And it was an important part in the entire bear market that we've seen so far this year. That just plus the interconnectedness of all these markets too, where everybody seems to be a counterparty of everybody else. I've spoken with traders that have money on FTX because, frankly, they just have no other option. There were always questions about that service, but it was kind of unavoidable. So it's the leverage, the interconnectedness, and then the greed.
Let's talk about crypto stocks, because they're also getting public. Coinbase is at its all-time low. So it's not just specific to the coins that are out there.
No. I mean, Coinbase right now, I believe, is about 90% down from its all-time high, but it's certainly not alone. Crypto stocks tend to trade in a tight correlation with each other, and they're all struggling. And Coinbase, I do find to be particularly interesting because it is an exchange, so it was a competitor to FTX, and right now it's seen as sort of it's domiciled in the U.S. It's subject to U.S. regulations. It is publicly traded, so it has audited and published financial statements. So on one hand, some people are saying, well, maybe Coinbase is in a position to come out ahead of all this because they're seen as a safe haven in a climate that is very uncertain. But at the same point in time, markets are crashing, trading volumes are going down, people are getting scared. So even if Coinbase's percentage of market share in the total crypto ecosystem is likely to go up because FTX was such a big player, if the pie is shrinking, it could still hurt Coinbase and its financials just due to lower trading volumes, which remain the largest revenue generator for that exchange and frankly every other exchange across the world.
Right. So how should investors read this? Is it kind of going to be a wait and see thing for the crypto space, or are we still focused on the longer term prospects of the potential that crypto has?
That's a good question. I mean, right now, I think investors don't like sort of like non-directional markets. And I mean, they like to be able to see a trend going up or down, and then they kind of know how to play it. Some are going long on some of the bigger assets, Bitcoin, Ethereum, but also there are institutions that are flowing into products like ETFs that are designed to short Bitcoin and other types of assets there. So there's a bit of a hedging, but right now, I think, I mean, this is very much a market reset. Events like an exchange like FTX collapsing just doesn't happen, and it's much bigger than even what happened in the spring. So really investors are kind of trying to sit tight and figure out what to do next. I even spoke with one quantitative trading desk where they told me that their models are now have reversed from sell, move into cash. Now they're saying buy, but they don't trust their models because they are just waiting for more contagion to happen, another shoe to drop, and they're just not quite comfortable to do that yet. So I think the best advice in a non-financial advice type of way is to kind of sit tight.
Yeah. Well, I mean, nobody had expected this black swan event. I mean, it felt as if just, different conversations that we've had with experts like you, that black swan or contagion really wasn't in the conversation. It almost seems as if the industry was blindsided, and to your point, by almost the white knight of the industry. And I think disappointment is one of the emerging emotions that came out of all of this, because it felt as if the underlying story was starting to be understood. And again, it goes back to poor risk control and over leverage, and to my point earlier, that's going to happen regardless, right? Every 10, 15 years, we talk about this in different asset classes, which is why, regulation is so important, not only from protecting investors, but also being able to stay ahead of the innovation game. I just think it's really important that we start to think about this framework, and I'm sure you agreed as well. So, Steven, over the next 2 days, before we get into Thanksgiving, and 2 days in the crypto space is a long time, what do investors really need to know before they sit down for Thanksgiving?
Well, anyone that's a real crypto advocate, last Thanksgiving, they were probably feeling pretty good about themselves. Bitcoin had just gotten close to about $70,000, and it was, I guess, 3 or 4 times bigger than what it is now. It should be ready for some hard conversations, but at the same time, there are some opportunities. And here's a couple of things that I know I'm probably going to have to say over my table. For one, this really is not, although it happened in crypto, it's not a crypto specific problem. Like, this is something that happens all the time in traditional finance, and just because of sort of the hot nature of crypto and the image that Sam Bankman-Fried created for himself, it just makes for really great copy for journalists, which obviously Forbes is working on pretty hard as well. But other than that, I mean, we need to clear out these bad actors so that more responsible companies can thrive, and I do think that crypto exchanges need to be regulated like banks. I know there's lots of investors that put their money into FTX and other exchanges, frankly, thinking that it's akin to a bank account. They pay yields, that they get involved in similar types of lending that banks do. I mean, most people don't understand what happens on the lending books for banks anyway, and they don't realize that these these accounts are not FDIC insured. So they need to, we need better regulation so that responsible actors come to the forefront. And then probably the other most important thing to note is it's very important for people to understand and take control of the security of their assets. Just because you see a balance on a screen doesn't mean the money's actually there. And one of the big trends that's come out of all this is that billions of dollars in Bitcoin and other assets are being withdrawn from exchanges into what's called self-hosted wallets, where an individual or an entity controls the private keys themselves, and no other actor has the unilateral control to do something like, say, take customer deposits and pass them off to a quantitative research fund that was also founded by the CEO of the exchange. So self-custody is an important thing because it's the one way that people can be sure that tokens will not be surreptitiously taken away from them. So I think those are a couple of things that people should kind of keep in mind as we move into Thanksgiving.
All right, Stephen, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Great. Thanks, Jill.